All right, my friends. So now we're going to use Karen and Ken, but this time we're going to have them suspending Social Security until they're both 70. I want to see what it looks like in terms of their overall balance sheet, cash flow, tax consequence, and obviously net worth as well. Secondly, we're going to increase their income needs, all right, their expenditures, if you will, from $3,500 a month to $4,000 a month on top of that too. And again, I'm not saying this is worst case scenario or anything. I just want to kind of play the numbers and see what we come up with. So don't forget to subscribe down below. As always, if you like what you see here, a thumbs up, comments, share the video, and let's dive right into this, if you will. So remember, the scenario was Ken and Karen. Karen had a $13,300 a month pension, which we're adjusting with a 3% COLA, cost of living adjustment. Ken had no pension. Karen and Ken combined had about $47,000 of Social Security. They're at 67 today, and that's what their Social Security benefit is. That's literally from the horse's mouth, from what Karen told me. All right, so she had $13,300 in pension, roughly $47,000 a year in Social Security between she and him. And lastly, they have $150,000 in IRA, traditional IRA money. CPA told them don't do any conversions. I don't understand that, but whatever. So we did the calculations on just doing conversions, and we showed you how we can save them over $100,000, easy peasy. But now I'm thinking, what if we suspend Social Security, right, in order to do a couple things, which is to pay our income needs by drawing down our IRA, as opposed to taking our Social Security right now. So let's see what we're looking at. So let's dive into this. Let's go. First thing I want to do is retirement. Let's go to cash flows. All right. So, and I'm not really all that concerned about the financial planning stage of this in terms of how much money they're leaving. At this stage, I don't care. I just want to see the cash flows, a tax consequence, and whatnot. All right. So here we go. $13,300 is their pension. Again, I have a cost of living adjustment of 3% a year on that. They have no other inflows, so their total inflows here is $13,300 from their pension and $13,300. $699 in 2021 from the pension as well. But they have expenditures of $52,000 and $53,000 the following year. So they got to make up those expenditures from someplace, and they're going to get it from taking IRA distributions, which means they have taxable income here. So let's take a look at their income inflows. Actually, no, bear with me just a second. I want my expenses, excuse me. So let's take a look at expenses. Now, I've raised their monthly expenses from $3,500 a month to $4,000, and they still have their housing costs, which is $3,000 a year in property tax and $1,000 a year in property insurance. They live in California, so their total expenses are $52,000, and those are inflated each year with 3%. So next year is $53,520. But again, their income inflows are only their pension. So they have a gap, and the gap is going to be made up by taking distributions from their, I don't know, you could do that. Is that mini tax? Oh, is that new? I didn't remember that. Let me, the min tax plan. I don't know what the min tax plan is. That's kind of cool. I've never seen that before. Min tax plan. Let me just go back. Is it doing anything up here? All right, it's going up. This is, I know it's offsetting here. I'm just curious. Is that doing? Okay, I don't know what that did. All right, min tax plan. So let's just go to, all right, so ending balance. I want to go to withdrawals from accounts. All right. So there's the IRA distributions that they're taking the money from because they have to pay the bills. All right. Now let's go to ending account balance. This is new right here. That is sweet. See, Right Capital, man, I'm telling you, they add stuff to this all the time. All right, so because they're taking those withdrawals from their accounts, their IRA balance when they hit 70 is only $88,000. That's it. All right, so now we go to summary, and they have Social Security at that point, and they have $88,000 of mandatory distributions. So they get $88,000, divide that by 27.4 because that's their first year RMD. And they have right about $3,300 of RMDs. All right, so now Social Security plus a small pension plus a small distribution, mandatory distributions. They have income inflows of $82,000. They have expenses of $55,000, and they have no taxes. So let's go take a look at the tax ramifications here, and I'll show you what I'm talking about. So let's go to details. And this is in 2020. So they got nothing from Social Security, but they have 54,968 from IRAs and distributions, and there's $13,300 in pension. So their total adjusted gross income is roughly 55,000. You subtract out their standard deduction, and their taxable income is 27,968. The first roughly 20,000 of that is taxed at 10%. The next is taxed at 12%, and that's their taxable income right there. $3,000 of taxable income of taxes they have to pay. So that's not too shabby. Remember, if we go to this thing right here, it'll tell us the effective tax rate. Their effective tax rate here is 5.4%, but it's $3,000 of their taxable income, $27,000. $3,000 of their adjusted gross income of $54,000. And that's going to give us, about 5.5%. So that's right on. So remember, that's the effective tax rate is the taxes that they actually end up paying on their adjusted gross income. All right, but it starts getting up and it starts getting bigger, as you can see. All right, so that's interesting. So now let's go to, I want to go to taxes in 2 years when they got Social Security kicking in. Let's go to 2024. So now they have Social Security kicking in. They have $67,000 of Social Security, of which only $13,000 is taxable. So that's about 25% of their Social Security benefits taxable. They have $18,780 in pension distributions and IRA mandatory distributions. All right, so $18,780 there, plus $13,000 of taxable Social Security, which means they have taxable AGI, adjusted gross income, of $33,936. Subtract out the inflated adjusted standard deduction of $29,803, and their taxable income is $4,133. So they only pay $344 in taxes. But I mean, if you really want to look at it, they pay $344 on this plus that. So it's going to be total Social Security, $67,855 plus $18,780. They have $86,000 of literally spending income, and they're only paying $344 in taxes on $86,000 of literal spending income. That's 0.004% of an effective tax rate. And it won't show it here. It's going to show on their effective tax rate, 2024 is going to show 0.5%. It's actually lower than that because they're not even including their Social Security as part of their tax, of their spending money. They're not, because Social Security, again, once you had a certain threshold of taxable income of Social Security, I mean, look, they got $67,000 of Social Security, but they're only having a $13,000 of that being thrown in their AGI. So I'm telling you, if you can maximize Social Security, you're in a good place. All right, so they don't run out of money. Let's go fast forward. Let's go fast forward until 2000. We'll just say 40. Let's say 40. 2040. All right, so here's their tax: 100,000 of Social Security, of which 58% is taxed. There's a taxable Social Security right there. All their IRA mandatory distributions and all their pension income. And again, all these tax brackets are adjusted for inflation as well. Means they have 126,000 of AGI, of which 25,000 is their standard deduction. Again, the line 9, they got labeled as QBI. It's not. It's actually personal exemption. Just Right Capital hasn't updated the software yet to reflect this, reverting back to the previous Trump tax bill. So here they get $88,000 of taxable income, of which $9,500 is taxable. But they actually have about $150,000 of income they can spend. So in this case, $9,500 of taxable on $150,000 of actually spending income. Their real effective tax bracket is 6.3%, which is pretty doggone cheap. I bet they're going to show 2040. I bet they show it. Yeah, it's still pretty close. All right. So that's interesting. So that's when let's go ahead and do the cash flow. Put on a spreadsheet here. All right, so let's cash flow this. Put this on a spreadsheet here. Did I already do that? I can't tell you what. I can't remember if I did it or not. So 165, 20,292 tax payment. Okay, let's get rid of this guy here. We'll just get rid of this whole thing. Boink. And we will come right there. All right. All right, so here their total income inflows because suspending Social Security is 2.3 million, and their total tax is $120,000. So that's a big win for them to suspend Social Security. Now the info is a little bit misleading simply because I am taking $4,000 a month of income needs, as before I only had 3,500, but that's income. That's interesting. All right, so their tax payment 120,000 with total income 2.32 million. All right, now what happens when they let's have Ken being killed off at 80, and let's see what that looks like. So we'll hit family here. Ken's going to be killed off at 80, and let's take a look at tax. I bet it's going to be a big bump. Yeah, sure enough. Look at that. Yeah, man, that's the widow's tax trap. I mean, right there, man. The widow's tax trap. They're paying 4.4 to the feds, 1.2 to the state. Ken gets hit by a bus, and now they're paying 10.4 to the feds and 2.6 to the state. All right, so let's see what that looks like from a cash flow perspective. And I'm not, well, maybe I will do the 1040, but by now you should understand how this works. I mean, so here's they're 80 years old. They got $101,000 of income plus mandatory distribution of 6266. So they have a total $107,000 of income in which they pay 3,803 in taxes. Right here, 3,803 in taxes. So $107,000 income, they pay 3,803 in taxes. They go down 1 year. Ken's dead. They have 27,000 less of income, which is a 25% reduction in income, and they have, I mean, that's 8,910 divided by 3,803. They have a 234% increase in taxes. I mean, just look at that. I mean, the numbers speak for themselves, man. There's no other way around that. So let's do a cash flow scenario of this. I find that I can do this till I'm blue in the face and be disgusted with it, and it's not going to change anything. But I mean, it just ticks me off. All right, so let's do this. All right, and so now we're going to do boink. All right, so 1.985 million of income, total income for these guys, but they pay $165,000 in taxes. So they have, I mean, they have 400,000 less of income, roughly 350,000 less of income, and they pay 45,000 more in taxes. It's just absurd, absurd. All right, so we're going to do Roth conversions next. We'll do that in the next video. I tell you what, let's do something else though. Let's do net worth. I'm just curious. We'll do net worth on both sides. All right. We'll save all this stuff. We do, let's just do that. And that's going to be with Ken dying, net worth, suspend, Social Security, 4K a month income, Ken dies at, or 4K a month expenses, Ken dies at 80. All right, yep. All right. No Roth. We'll do no Roth, okay. So now let's go back here. I have Ken living to 90. Profile. Family. Oops. Ken live until 90. All right. God, that had 80. Why does it show up as 83? That shows 83. Yeah, what the heck? 90. Okay, there we go. Hit save there. All right, so now let's go to net worth here. And notice not one time we worried about them running out of money. Why? Because Social Security. That's a net worth here. Good. There we go. Go back here. Let's do it right here. Same as above, but Ken dies at 90. All right, so now total net worth here is 1.893 million. Total net worth there is 1.532 million. So they have 1.893 million in total net worth when Ken dies at 90, and this is the one where they had let's see, that's 80. This is the one they had 2.23 million of income at $120,000, which makes sense. I mean, they had simply because Ken lives longer, he has more time, they have more income coming in from Social Security. There's just no two ways around that. So not only do they pay $45,000 less in taxes when Ken lives until he's 90, not only do they have 400 or 350,000 more of income if Ken lives till he's 90, but they also have a higher net worth. That just makes sense. I mean, 1.83 million. But notice, my friends, qualified assets here are only 106. That's not that bad. Yeah, 106 on both sides because they're not doing Roths. But the non-qualified assets 962, and the non-qualified assets 1.322 million when Ken lives till he's 90, and that's good. That's what we want. We want to leave high non-qualified assets to the kids and low qualified assets to the kids. And the only reason for this is Ken living longer. They have 25% more income being used in which to accumulate assets in the future. All right. So what we're going to do next, we're going to do Roth conversions and see how that looks like with Roth conversions. I keep looking and waiting on my daughters to text me. So if you wonder why I keep looking over that, that's why. And be interesting. So let's see what Roth conversions look like on top of delaying Social Security. All right. So don't forget to subscribe, share the info with other folks, and of course, comments and thumbs up. And we'll see you next time. Thanks, guys.